Okay, so welcome everyone. Really good to be with you today. My name's Steve Gitlin. I'm Senior Vice President of Investor Relations at CORZ Scientific. It's good to be with you here personally. We also have a live webcast going on, so we also welcome everybody who's tuning into the webcast and who may be listening to the recording later on. It's great to give us the opportunity to tell our story and update you on what we're doing and where we're heading. About 6 months ago, we had a similar event to this, and I know there's at least one person in the audience who was there 6 months ago. And at that time, we introduced our presentation by saying we had been pretty quiet, but we had been really busy. And here we are about 6 months later. We're not as quiet, but we're even busier, and it's busy in a good way. And we're really delighted to be here together to tell you a little bit about what we've been working on and what we've been so busy on. Our whole team, you've met everybody, you've met a lot of people today. Our whole team's energized, and we're really excited to be energizing all of you, our customers, and the opportunities that are ahead of us. This is our safe harbor statement. We're now on slide number 2. And of course, those on the webcast are viewing the slides in real time as well. Today's agenda is pretty straightforward. And also for those who are listening who don't have access to the live slide view, a PDF version of this presentation is available on the CORZ Scientific website under presentations, so you can follow along with us. So today you'll hear from our CEO, Adam Sullivan, our CFO, Denise Sterling. After Denise, the plan is we're going to take a short break. We'll have a buffet lunch outside. Everybody can go outside, grab a plate, bring it back in here. We'll pick that back up again with Matt Brown, who will lead the last portion of our presentation. We will have a time for Q&A at the end of the session. We ask that you please hold your questions until then. And we're also making available question and answer to those listening on the live webcast. So there should be a dialog box on the webcast pane where you can submit written questions, and we will be looking at those and selecting those that we can also add to the mix here in the live event. Today's speakers, as I mentioned before, to my right, Adam Sullivan, Chief Executive Officer, Denise Sterling, our Chief Financial Officer, and then Matt Brown, our Chief Operating Officer and Head of Data Center Operations. In terms of objectives, we want to make sure that everybody here today in person and virtually understands the structure and mechanics of our recently announced 200 megawatt deal with CoreWeave. We know there have been a lot of questions about that. We want to go over that very carefully and deliberately. We also want to make sure that you have an understanding of the broader HPC opportunity, HPC being high performance computing. We're very excited about it. There's obviously a lot of press on that. We hope to provide a little bit more background and context around what's happening there. Matt will focus on our build-out approach and our plan for doing so, and why we believe that we're uniquely suited to execute our plan successfully. And then throughout today's discussion, the underlying goal is to describe how all of this combines and works together to create shareholder value. With that as the introduction, it's my pleasure to introduce Adam Sullivan, our CEO, who will take it over from here.
Thank you, Steve. And it's great to be with all of you, both in person and on the webcast and recording. We got to go up a slide. All right. All right. One of the things that I can assure everyone is that our entire company and our board have been working extraordinarily hard to create shareholder value. And we're going to continue to execute our plans to continue to grow this company. At CORZ Scientific, we deploy high power infrastructure to energize compute in 2 businesses. The first is Bitcoin mining. And we remain a leader in owned infrastructure, deployed miners, hash rate, and energy efficiency. The second business is hosting, first for our clients on the Bitcoin mining side, and second are for our clients on the GPU side. And this is the part of the business that we're actually going to be discussing in a lot more detail today. To understand our investment thesis, it's really important to understand where we came from and how we started, because it really leads to where we're heading. So from our early days, one of the things that we really understood was the value of rapidly scaling infrastructure to support high value compute. We took an infrastructure first approach to Bitcoin mining, seeking sites that met a very defined criteria. We looked through the lens of a data center design to engineer our sites for flexibility, connectivity, and longevity. We believed that Bitcoin mining was the start of a larger business, but not necessarily the end. We rapidly grew our infrastructure by diversifying our footprint across multiple regions and jurisdictions, securing economic incentives and also large power allocations to support our operations across the United States. And while we couldn't expand during our restructuring, which was certainly a trying time for our team, we improved our operations, and right out of the gate, right out of our restructuring, we leased the Austin data center facility as soon as we emerged to show that we can execute on our HPC strategy. That really leads to an unmatched platform of operational infrastructure in the industry that started from Bitcoin mining and really Bitcoin mining hosting as well. That's what you see here on this page. And the interesting part is our portfolio actually consists of both greenfield sites. So there's a number of sites up here that are greenfield, but also brownfield data centers that utilize unused manufacturing that we converted into Bitcoin mining. And that's something very unique to our business, is that back when we first started, we were actually going into locations that had industrial zones that had built out large amounts of electrical infrastructure that sat idle. And those communities needed people to come in, use the power, and actually employ the people in those communities. And so we actually represent a very meaningful percentage in many of our communities of the people that we employ. At some of these sites, we have partially developed infrastructure. Today at Denton, we talked about how we're actually going to be completing 72 more megawatts before the end of Q2 at that facility. And so that's something that we're really excited about. In total, we have a significant number of megawatts that we're going to walk through in a moment of partially developed infrastructure. The highlight here is our extensive infrastructure has really enabled us to earn more Bitcoin over the past 3 years than any other publicly traded mining company. We've mined more than 36,000 Bitcoin since 2021. And really, when you look at this slide, no other miner comes close. We've learned a lot over the course of the past 6 to 7 years about facility design, about software development, about maintenance, and much more. One of the things that we discussed is our Denton facility actually is operating our 4th generation data center design. We've had to go through trials and tribulations across multiple jurisdictions in terms of our design. We've been able to optimize that over time to develop what is really the best in class infrastructure for this industry. We've also installed more than 700,000 machines across our facilities. That's something that most other people can't say. And we've done it for more than 16 manufacturers. I know most people only think about 1 or 2 manufacturers, but we've actually installed more than 16 manufacturers over our lifetime in our facilities. So we've learned a lot about that process. And that really gives us unique insight into the practical demands of Bitcoin mining and data center operations. And it really informs our software and our hardware development. And so we're much further advanced in terms of what we're able to put in our facilities from a hardware perspective, not only on the machine side, but also on sensors, on incorporating different types of weather data, whether it's from our own systems and sensors in our facilities, but also third-party systems as well to actually create an optimized software stack for given conditions. This is a great slide that we like to go back to. Fundamentally, at our base, we really transform energy into high-value compute, and we do so with superior efficiency at scale. Our assets developed for Bitcoin mining really serve as the basis for our value proposition, because we can deploy those assets into multiple different forms of compute, as was highlighted by our most recent announcement. And that's really because as this market for compute continues to grow, it becomes more specialized. And that's really what you're seeing today, where the cloud was step one in terms of a large growth in compute. But what you're seeing as GPUs become more advanced is application-specific digital infrastructure is necessary to run these in the most efficient manner, and that's what we do best. So as you can see, we currently have 1.2 gigawatts of contracted power. That's power that utilities have allocated to us for our use only. Of that 1.2 gigawatts, we have 745 megawatts of operational infrastructure. That's powered infrastructure at our sites that today are used for Bitcoin mining. About 455 megawatts are partially completed, meaning that we've done the preliminary work that includes substations, transformers, pads, etc. Now, of that 745 megawatts of operational infrastructure, about 600 megawatts support self-mining today. And about 145 megawatts support our Bitcoin mining hosting clients. Of the 455 partially developed infrastructure or partially developed megawatts, about 355 megawatts are at our 2 Texas sites. So both Denton and our Pecos location, and about 100 megawatts at our site in Muskogee, Oklahoma, that we announced a couple of years ago, but we have not yet completed. Expanding our hosting offering to HPC is going to result in a reallocation of our infrastructure portfolio. So what you're seeing here is, we aim to provide 700 megawatts for HPC, of which 500 megawatts will be for the hosted GPUs. So that's about 200 megawatts that are needed in order to support those facilities. And so the 500 megawatts represents the direct power to the GPUs. Unlike our Bitcoin mining facilities, which do not require much additional power to support the machines, our PUE across our Bitcoin mining facilities is below 1.05. HPC hosting requires multiple ancillary items such as air conditioning and cooling for the liquid that's actually being used to cool those machines. This leaves about 500 megawatts of our existing portfolio for Bitcoin mining. The upcoming expiration of our Bitcoin mining hosting clients will likely not see renewals, providing us with the opportunity to focus the Bitcoin side of our business on self-mining. And as we recently announced, 200 megawatts of HPC hosting infrastructure is going to be dedicated to CoreWeave, and that requires about an extra 80 megawatts of infrastructure to support those contracts. That leaves us with about 300 megawatts of megawatts to GPUs to host other clients potentially or CoreWeave, along with another 120 megawatts needed to support those facilities. Throughout this reallocation, our 16 megawatt data center in Austin will remain operational. All right. So the HPC opportunity we're capturing is driven by dramatic growth in the data center industry, which in turn is really being driven by this explosion in AI compute. I would imagine, not just this chart, but there's probably a few hundred different charts you could pull up that would illustrate the dramatic growth in global data center demand from 2023 to 2030. But it's going to more than double over the course of this next 6 to 7 year period. And that's really in the base case. Because it takes years for new data center capacity to come online and become available, this dynamic is creating a very unique opportunity for those with high power data center capacity and the teams that know how to do it. And that's really something that I like to highlight is we not only have the infrastructure assets, we have them spread across the United States, but we also have a best-in-class data center team that can execute and deliver for a very constrained industry today, where those teams are struggling to get the manpower in order to actually continue building out alongside of the demand that they're seeing. Technology companies are very eager to get their GPUs to work. On average, GPUs per megawatt are about 25 to 30 million per megawatt. And so the longer it takes them to plug those in, the further behind they get in the AI race. And so we're really addressing this via a shorter time to power. That's the biggest challenge in this industry right now. And through the modification of our data centers for HPC hosting, we can capitalize on that opportunity. While we are reallocating our infrastructure to seize on the HPC opportunity, we also remain committed to our Bitcoin mining business. The 760 megawatts you see here on the left includes our Austin data center. On the right, you can see how we're diversifying our infrastructure portfolio across Bitcoin mining and HPC hosting. Our agreements with CoreWeave do represent the first significant move for our portfolio to achieve this reallocation, but it's really just the beginning for us. So let's dive into some of the highlights of that transaction. Our agreements with CoreWeave move us firmly into the HPC hosting market. This is one of the largest AI hosting deals ever announced, and in fact, one of the largest data center deals announced. Importantly, as I highlighted a moment ago, after allocating the 200 megawatts for CoreWeave, we still have another 300 megawatts to offer for HPC hosting. These agreements put us squarely into a new hosting market segment with strong, long-term, and stable cash flows. Denise is going to provide actually a much more detailed review of this with a revenue and profit model for this type of deal so that everyone can more clearly understand the structure of the contract. But this 200 megawatt deal by itself helps stabilize our business model, reduce our risk, and generate significant shareholder value. So we talked about the 200 megawatt HPC infrastructure deal and the fact that it requires a total of 280 megawatts. These agreements represent about $3.5 billion in total revenue over the life of these contracts, with an average of $290 million per year. We're anticipating a profit margin between 75 to 80% for these agreements, and that's over a 12-year term, while CoreWeave has 2 5-year renewal options on top of those 12 years. Unique to our agreements is that CoreWeave is paying for all the CapEx, which ranges from 5 to 8 million per megawatt, and we're crediting them in total 300 million for our portion of the CapEx against their hosting payments until it's fully repaid, or about 1.5 million per megawatt. Additionally, just to ensure it's clear, CoreWeave will pay for the power and utilities as part of their contract. We expect to begin modification of the designated sites in the second half of this year, and we expect to achieve operational status in the first half of 2025. Considering the remaining 300 megawatts of infrastructure for HPC, the full 500 megawatts could generate more than $8 billion in revenue over a 12-year term. We've been working very hard to lever the valuable asset portfolio we've built and generate the highest return for our shareholders. By expanding our hosting business into HPC, we expect to achieve a number of critical areas, which the first one is bring more balance into our financial performance, increase our earnings power, build on strong competencies in data center design, building, and management, as well as our technology development, and introduce a new model for data centers. This was a ground-shaking deal for the data center industry, and we look to continue to capitalize on that. And really expand our platform from our Bitcoin mining base to accelerate our growth and the value that we create. At Core Scientific, we're very excited about our future, and our team is fully aligned, and engaged on the journey ahead. Now I'd like to introduce our CFO, Denise Sterling, to discuss our financial performance.
Thanks, Adam. It's nice to be here with you today, and I am going to go ahead and get started. So let's just dive right in. I'm going to begin by providing you with the highlights of our business today, as well as sharing with you where we're actually headed. Today, we are well positioned for continued growth. We are the top producer of Bitcoin among publicly traded miners since 2021. We operate the largest owned infrastructure at 760 megawatts, and as Adam suggested, we have power up to 1.2 gigs. We are also effectively navigating the halving with putting in place strategies in order to improve mining economics during this low hash price low hash price environment. And we continue to fund our growth through operating cash flow. We've also began to delever our balance sheet by paying off $19 million associated with the completion of 72 megawatts at our Denton center that you just visited. And we're also delivering strong gross margins as well as management of expenses compared to our peers, which I'll talk to you about right after this. And finally, we're expanding our hosting business and really diversifying our customer base into the high value compute, which is obviously one of the topics we'll dive into in more detail. So let's go ahead and get to the next slide. During 2023 and Q1 of 2024, as I mentioned, we produced the highest gross margins as well as the lowest operating expenses as a percentage of revenue amongst our peer group, including Marathon, Riot, as well as CleanSpark. We generated a gross margin of 25% for 2023, which increased to 43% in Q1 of 2024, which is ahead of our peer group across the board. From an operating expense perspective, we outperformed We outperformed again across the board with 22% in 2023, reducing to 9% in Q1 of 2024. So across the board have done a fabulous job compared to our peer group. Now I'm going to shift to where we're heading longer term and continue to diversify our hosting customer base. As following the success of our initial HPC deal with CoreWeave for the 16 megawatt data center in Austin, we've continued to build our HPC capabilities, taking advantage of the rapidly growing, expanding HPC and AI compute opportunities. We're expanding our hosting business, allows us to diversify our top line by reducing the exposure to overall Bitcoin volatility, as well as reallocating a portion of our business to a US dollar denominated, stable, high margin set of revenues. So let's dive into a little bit more detail. As Adam suggested, we think it was really important to be able to provide you with more granularity around this HPC deal for the 200 megawatts. So let's dive in. As Steve outlined, one of at the outset of the meeting, one of our objectives for today is to explain the mechanics of the 200 megawatt deal with CoreWeave, which I'm going to spend the next few slides walking through. So I'll begin with the key deal terms, which you see here, and we thought it was important to actually set the stage because what Adam and I talked about in Q1 was really the beginning of where we thought this journey was going to take us. And so I think it's really critical for us to be able to set the stage with where are we with, comparing what we actually communicated in Q1 during our earnings call in May with where we actually ended for this 200 megawatt deal. So all metrics from the deal term perspective are aligned with what was communicated during the call. Our revenue is $1.45 million per year per megawatt, which is within the range of 1.4 to 1.6 million, which is what we had suggested during our call. As Adam suggested, we also told each one of you that we were going to be between 75 and 80% margin. What you're going to see modeled on the next slide is that we're at the outer end of that range at 80%. We all power and utilities, which I think is absolutely critical, will be a direct pass-through to CoreWeave. So it's not included in what we'll show you in a moment. And we suggested that approximately 700 megawatts, as Adam suggested, was going to be allocated to our HPC business. That actually equates to about 500 megawatts of HPC hosting, which is important because that's really what's allowing us to generate revenue. 200 megawatts of that is what we refer to as HPC support, as Adam suggested. We've also communicated a range for CapEx. And so if you remember, and what's on the slide here is that we actually, all investments that are ultimately going to be paid by CoreWeave, but when we set the stage in May, we shared with you that the conversion is actually between 5 to 7 megawatts or 5 to 7 million per megawatt. A greenfield project is between 7 and 12 million. So I think what is critical is, and as Adam suggested, we want to make sure it comes across loud and clear, is that CoreWeave will fund all investments associated with these build-out costs for that 200 megawatts. What I think is critical for you all to understand is that the first 1.5 million per megawatt is actually going to be funded by CoreWeave in order to build out those data centers. And that infrastructure will be owned by Core Scientific and is going to be offset from a revenue perspective at the beginning of the contract. As important is anything above that 1.5 million is actually also an obligation of CoreWeave. They will actually own that infrastructure until the end of the contract, which is when they will actually transfer it to Core at a nominal cost. So again, critical to this presentation is just understanding that they will actually be on the hook for 100% of the infrastructure build. And then lastly, we talked about the actual conversion and ultimately it taking 3 to 4 years to actually convert all 500 megawatts. What you see here is that we're actually going to be up and running in the first half of 2025. So with that, I'm going to take a little bit deeper dive. So in addition to the key deal terms, we thought it was absolutely important to walk you through a simple and illustrative example of how this will actually play out from a financial perspective. Over the next, what I would suggest is I'm going to start on the lower left-hand corner. You can see there that the 1.5 million equates to 300 million of investment from CoreWeave in 2024. That is actually going to be recorded as deferred revenue, and it will be offset against our hosting revenue in the beginning of the contract at a 50% rate on a monthly basis. And so we'll walk through that in a moment. Over the next several quarters, we're going to continue to build out our infrastructure. If I can move to the right, in 2025, which is year one, we will be in a position to actually operationalize that 200 megawatts and begin generating revenue. So if I can take you to the table above, as Adam suggested, we have about $3.5 billion in revenue for the 12-year term. That includes base license fee. It includes our deferred revenue, as well as annual escalators. And that is it's actually straight lined over the life of the contract. And so you see there $290 million in revenue on an annual basis. The expenses include not only facilities operations, but it also includes security. It includes repairs and maintenance on our owned infrastructure, as well as additional FTE, property tax, and insurance. It is estimated today that that is going to be about $58 million per year. And so you can see there that we have a margin of, I can't actually read it, so we have $222 million. What we're referring to down below is the actual offset or the rebate that is actually being paid to CoreWeave for the $300 million that they had contributed in 2024, which I had suggested was going to be offset against revenue. So we actually have the $145 million is basically the equivalent of 50% of the $290 million in revenue. And so we're calling that sort of the after credit profit, as well as the after credit margin, and that is at 30%. If I move you to year one, you see a very similar situation. It's not until year three where we actually see a slight adjustment based on the fact that we only have $10 million of additional cost in order to rebate back to CoreWeave through our hosting revenue. And so you start to see the margin improve as you move to the right. For years 4 through 12, that's when we have actually paid off this contributed capital. And ultimately what we're going to see is an 80% margin for years 4 through 12. So I know that that was a lot to sort of take in a short period of time, and we certainly have time for Q&A. But just wanted to be able to actually walk you through at a high level the actual economics. This is illustrative. It's a very simple way of looking at this, but I think it'll give each one of you just a sense of ultimately how this contract is going to play out once we actually enter 2025. So with that, I think the next item on the agenda is for us to actually go out, grab lunch, and then we will come back and we will hear from Matt Brown, our COO.
Okay, thank you. Great having everyone here today. Super exciting time for Core. So what I want to walk you guys through over the next few slides is sort of our approach to digital infrastructure. Number one, we'll cover some updates around operations, and I'll talk a little bit about kind of what we see as some emerging trends. First off, I know we're all excited about HPC. It's been in the news lately. If you haven't been paying attention, but this company, as Adam indicated earlier, we're laser focused on mining operations. We're not taking our eyes off the ball. And if we just do a little overview of our 2024 performance here and the incredible work of our operations teams and that they're doing on a daily basis. And I'd be remiss if I didn't give them a shout out. I mean, those guys every single day are just killing it. So, uptime and hash rate utilization, top quartile in our peer group. We're continuing to focus on our energy efficiency, driving down our joules per terahash, optimizing our fleet. We've been deploying miners this year, more than 28,000 between XPs earlier in the year and S21s earlier in Q1. Grid support, we've been busy since 4CP started here in Texas. We're up to 73 gigawatt hours of grid support, around 200 events. And our operations teams and supporting keeping hash rate online are contributing to our bottom line by restoring more than two exahash back into operation through our repair services. So a little bit about our HPC side. As Adam mentioned earlier, it's like we're about designing to application-specific infrastructure. And I'm going to walk you guys through here in a few slides around our approach to what we coin as application-specific data centers. So on the operations side, 1.2 gigawatts of infrastructure, contracted infrastructure, 500 megawatts we have allocated to HPC just for rough order of magnitude math, so people can sort of translate what does that mean in GPUs. It's about roughly around 300,000 Blackwell GPUs is what we have the capability of supporting, within that footprint. On the performance side, our Austin data center has performed flawlessly since we commissioned that for CoreWeave earlier this year. So 16 megawatts up and running. We delivered that, more than a month ahead of schedule from where we expected, 100% uptime. And as Adam already mentioned, around our 200 megawatt contract with CoreWeave, we're in process of executing the delivery of those 200 megawatts today, right? And on the efficiency side, our Austin data center efficiency around HPC 1.4, which is kind of in line with our industry peers from that standpoint. But we expect that to continue to drive down as we can convert more megawatts to that. And then on a global basis, if we sort of combine our HPC and our mining, we're below 1.2 on the mining side alone, below 1.5 on the PUE side. So, energy efficiency, operating efficiency is at the top of our minds on a daily basis. So sort of in a sort of illustrated timeline on the delivery of the 200 megawatts. So we had three tranches of megawatts, 80, 80, and 40, all being delivered in the first half of 2025. Some of those megawatts will come on earlier, but some of but we expect all those megawatts to come on before the end of Q2. And so what are some drivers? So from our standpoint, when we sort of look at some of the emerging trends from the technology space, there's really like two things that are really happening here. One is we're sort of leaving the era of general computing, x86 architectures, which is sort of in the era of transistor scaling via Moore's law. And we're going into into an era of system scaling. Heterogeneous architectures like Grace Hopper GPU architectures is an example of heterogeneous architecture. ASICs chips and used for blockchain is another example of an application specific architecture to where you gain efficiency at scale through scaling the systems, not scaling the individual transistors that are embedded on the chip. And so this move to sort of specialized computing architectures, GPUs, FPGAs, ASICs, and quantum more out into the future from now only positions us to be in the right place with the right type of data center approach. And so I was talking to somebody the other night, and I'm going to steal a term from them. And it says, hey, essentially what you guys are doing, you're trying to ASICs the data center. ASICs being an application specific integrated circuit, which is predominantly used in Bitcoin mining, where it's highly optimized to do one thing. And essentially that is our approach to data centers. It's like application specific, highly optimized for a specific type of workload. And to the left of this graph, you see what some of the examples of what some of those workloads we expect to be. Everything from AI and machine learning, which is what we're experiencing now with the current growth. Blockchain, which is something we've been doing for a while and have become incredibly proficient at. But IoT, scientific computing, autonomous cryptography, and then the types of technologies used that are application specific, GPUs, ASICs, FPGAs, TPUs, DPUs, quantum, neomorphic, homomorphic. These are just all emerging technologies that require application specific infrastructure to support them. So our position is that the data centers that have been built in the last 20 years are no longer suitable for the future of computing going forward, right? And I'll get into more what that means. So our approach to So a little bit about the application-specific data center and what it means to us. It means incredibly high power densities, greater than 100 kilowatts per rack. Just to give you a frame of reference, the 2023 survey from the Uptime Institute that sort of measures one of the questions they ask is what's the average rack density, power density of the racks in your data center? It's less than 6 kilowatts universally across the board in aggregate, right? So for us, we're designing for the future. We're designing for incredibly high densities with more than a gigawatt electrical infrastructure capacity, designing to 100 kW per cabinet, dedicated large footprints, which is also something from a business model standpoint. We're after customers that need to operate at scale, at density at scale. So 14 to 200 megawatts type footprints, 25,000, 250,000 square feet type footprints is what we're talking about. So this is truly like exascale level type of computing, which is something that's really non-existent in the marketplace today, right? And given the amount of assets we have in the ground, given the amount of contracted capacity we have in the ground, we have a lower cost per megawatt. We can build faster, and we can get our customers' GPUs into the market quicker. The high capacity fiber providers is just something we have naturally built into all of our sites. So we already have diverse fiber carriers, diverse paths, enough fiber optics to support AI. And then our future model is everything will be liquid cooled in our data center, HP's data centers going forward. So direct liquid to chip. And our approach to design with an application specific data center differentiates from a traditional data center that you might see on the market, is that most data centers are designed for one monolithic use case or one monolithic tier. And if I think about data center tiers are essentially, according to the Uptime Institute, you have tier 1 through tier 4. Those just indicate the levels of redundancy and resiliency and how much equipment you have that will correspond to an uptime calculation, or your ability to maintain a site under failure scenarios or under maintenance scenarios. And then our approach is, instead of building one monolithic tier, one data center to be all tier 4 or all tier 3, it's like we want to take more of a targeted approach with that. And so what we call the zoned multi-tier. And when I get into the illustrative example here in the next slide, you'll get a good picture of what that looks like. But essentially, if we can target resiliency that is truly optimized and tailored to the underlying application, and then that allows us customers to sort of balance reliability with cost effectiveness and economics. So an example of what we start with when we build a Bitcoin mining site. So what you're going to see here is an illustration of two buildings. And when we build a Bitcoin mining site, we build a substation, we have a tech center, and we have a main distribution frame. This is the main distribution frame, essentially where we land all of our carriers. So all of our fiber connectivity comes into one spot, comes in through diverse paths into this spot, and we distribute out to the rest of the campus from there. We have medium voltage distribution transformers. So our medium voltage from the substation to the buildings, we deploy those. Then we add in our ASICs miners, our switchgear, our PDUs to power those miners. And then we have two big cold aisles on each side of the building, one big hot aisle, and to allow for airflow and exhaust. So this is essentially what a Bitcoin mining facility looks like today for us. So what does it look like when we transition to make the transformation to HPC? Well, we start landing in generators. We land in chiller systems. We incorporate in our buildings what we refer to as power zones. So these power zones are where we're landing the UPSs, our lithium batteries, our switchgear, et cetera, to power the GPUs. And the mechanical plant, the chillers, the generators, the battery systems is where the incremental CapEx comes in. in order to deliver this type of infrastructure. And then we get into the actual IT kit itself, being the GPU, what we refer to as GPU zones and spine zones. And in this type of architecture, it sort of goes back to what I was talking about earlier with the sort of the zone tiered approach. So not all computing architectures are the same. I can say the same thing about cloud software, understanding what your needs are, of your hypervisors, of your control plane, of your network and storage fabrics, where to target resiliency and uptime. The same thing with AI. When we look at the infrastructure stack for AI and the use cases for AI, we can sort of take a zoned approach with that. And those zoned approaches are, well, not all AI is equal. So we can have inferencing zones and we can have training zones, and then we can tailor the infrastructure to those specific zones given the uptime and resiliency that the client wants or desires for that type of workload. And then in the spine zones, you can think of these as all the shared services that the GPUs need. They need robust, high capacity network services, interconnection. There's a control plane, there's storage and storage fabric. These are things that are super mission critical to run the application workloads, to run the GPUs. And so therefore, our approach here is to target these areas for high levels of resiliency by giving them, additional backup capabilities, power backup capabilities, cooling capabilities, et cetera, so that allow concurrent maintainability of that portion of the infrastructure, whereas the GPUs may not need to be 5 nines of availability, but maybe 2 nines of availability or 3 nines of availability may suffice. And so, again, our approach to data center architecture is very, very different than what you might see with a data center provider that's building, 100,000 square foot data center and making it all tier 3 and not taking a target approach with that. So how does that compare to the market today? So when we think about what we're doing, what problems we're solving, to what I will call the conventional sort of colocation offerings that are out in the market. And I'm being a little bit unfair. This is certainly in the aggregate, but if you were to go out to the marketplace today with high power demands, what are you going to run into? Well, what you're going to run into primarily is, well, a lot of fragmentation of capacity. You're going to ask for 20 megawatts, 50 megawatts, 200 megawatts. You're not going to find it. You're going to find providers that will give you 1 megawatt here or 2 megawatts there or 3 megawatts over here, but it's going to be highly fragmented capacity. So that's the first thing you're going to run into. Finding contiguous high capacity is going to be incredibly difficult right now. Number two is a lot of these data centers that have been built in the last 20 years are predominantly air cooled. So getting water cooled at scale might be difficult, and so customers are running into that problem. And even data center providers that sort of advertise, they have DLC or water cooled to the rack, it's highly fragmented again. So if you have a data hall that only has 1 megawatt of capacity, you're only delivering 1 megawatt of water cooling, anyways. And then that's going to be scattered around the facility. It's not going to be optimized for what customers are trying to do with their, high powered AI training workloads. And then the third thing you're going to see is that the ultra low densities. Again, I'll reference the Uptime Institute's 2023 survey. 2024 is not going to be that much different. The density per cabinet in aggregate's less than 6 kW across the board. And it's just because, what data centers we're solving for over the last decade or more has not been optimized for high density compute workloads. It's been optimized for the general area of computing that we're exiting out of. General computing, x86, Moore's law scaling. Now we're in a totally different area of compute acceleration. And on our side, we're solving for these problems. Like from a Bitcoin mining standpoint, we already designed our facility to more than 1,000 watts a square foot. Right, 50 megawatt building with 50 megawatts is a pretty typical footprint for us today. We have large amounts of contiguous capacity, 25,000 square foot footprints to 250,000 square foot footprints, 14 to 200 megawatts. We're designing for water cooled at scale. Every single cabinet in our data centers, all 200 megawatts for CoreWeave, will all be water cooled. And then our approach, the tiering, is highly optimized. It allows us to build faster at a lower cost and get GPUs to market quicker. And then our densities, again, we're designing to above 100 kW a rack. We're likely in future iterations of our designs are going to be much higher than that, but we're designing that and future-proofing high-performance computing at scale as part of our design. And that's all great. All the infrastructure, our design approach, novel, unique, but it all needs to have services. It's kind of wrapped into it. So if you think about what Core Scientific has been good at for a number of years, it's like we're really, really good. Operations teams are really, really good at maintaining high availability, high uptime. Even in the Bitcoin mining world, our uptime is pretty impressive, right? We're really, really good at moving hardware. There was a period of time in 2022, late 2021, early 2022, where we moved 70,000 ASICs miners in about 45 days. Not just move them, but we moved them, installed them, and energized them, and we're generating revenue in day 46, right? Which is really impressive, and you don't do that unless you have a team that knows exactly what they're doing. Logistics, supply chain, etc. You know, we have a robust crack software team with expertise from Microsoft, AWS, etc. So we know how to write software. We know how to deliver internal capabilities that are unmatched in the industry. Then our network and planning services, like running AI, requires a lot of bandwidth, requires a lot of connectivity, both within the site, but also getting fiber to our sites. And so we have a team or experts in route diversification, carrier planning, low voltage planning, and high capacity fiber networks, and being able to deliver that infrastructure at scale. And I would not. The other thing we're incredibly good at is delivering power. And you don't deliver power unless you know how to acquire the power, which comes in the form of working with utilities, working with grid operators, negotiating PPAs, negotiating rate structures, tariff structures, sort of optimize our cost of running our facilities. And we have an incredible power team, which is able to offer sort of tremendous value to our high performance computing customers on a go-forward basis. And then I would not say like 24/7 security, super critical in this space, in the HPC space. So what you'll see in our HPC data centers is multiple layers of security, 24-hour guards, remote monitoring, alert detection, etc. So I can't say enough about our security team and the work they have ahead of them, but we're going to have the most secure facilities in the world when we're done. And all of that's not possible without a rockstar team. And what I'll point out here, so much the individuals, while the individuals are all fantastic, for a company that was born as a Bitcoin miner, we have a lot of Fortune 500 digital infrastructure experts in our staff. It's not just my direct staff, but it's multiple layers in the management. The names that we have here, a lot of Hewlett Packard. I built an entire team by pulling in people that had worked for me at HP years ago. They all know their roles. They all fell into their place. We know how to run enterprise infrastructure very, very well. Like we're an enterprise data center team, or a team of experts that sort of learned Bitcoin mining and adapted our skills and expertise to Bitcoin mining. So the fact that we can go back to HPC is really natural for us. And some of the names here: Digital Realty, Equinix, Hewlett Packard, DataBank. I mean, the list goes on the deeper I go into the organization. So I'll often get asked a question like, what you guys are doing, can it be replicated? it's sort of like an if then else kind of logic answer, right? And the answer to that question is, well, if you happen to have more than a gigawatt of power infrastructure allocated to you, if you happen to have the right infrastructure, power assets in the ground, if you happen to have selected the right sites in the right locations with the right building form factors, and you have the right team of digital infrastructure experts, then it's like, yes, then maybe you can probably do it. But that's a lot of hurdles. That's a lot of ifs to replicate what we're trying to do right now. And the team is really a big portion of that. So thanks for everyone being in attendance, and I'll hand it back.